If you win $1, right? So you're risking 1 to make 1, correct? But for most people, when they go into the stock markets, the trouble is because of their emotions, they lose more when they're wrong and they make less when they're right. Let me give you an example. So most people, what happens is if they buy a stock, say at $10, right? They say it's gonna go up, yes, I believe it's gonna go up, right? And sure enough, it doesn't go up, right? It goes down, and what happens? Right? They say it'll come back tomorrow, it'll come back tomorrow, it'll come back tomorrow, and they keep holding onto a loser till it loses big. They get a big fat loss. Yeah? And most people, when they buy a stock and it starts going up by a bit, say $11, $12, say, they made some money, and they say, let me take my profits before I lose it, and they take small profits. Okay? So most people, because of instant gratification, the moment they make a bit of money, they want to sell and take it off the markets, right? So the instant gratification causes small wins, small profits. And the fear of losing money causes people to not want to cut their losses. So when they make a loss, they say, it's going to come back, it's going to come back, let me give it some more time, I'm going to have hope, right? And a small loss balloons to a large loss. So as a result, most people win small, they lose big, and they're right half the time. So you do the math. In the end, they always lose money. Now, as professional traders, we always make money at the end of the day. How do we do that? We replicate the business model of the casino. So I explained how the casinos rig the game in order to have a statistical edge over the player, right? Now I'm going to teach you how, as professional traders, we rig the games. We rig the stock market. Legally, of course, right? So like I mentioned, most players, when they buy or they sell a stock, it's a 50-50 chance. It either goes up or it goes down. But as professional traders, what we do is we study the markets. We look for repeatable price action patterns, or we call it technical analysis. And by applying these price action patterns that are repeatable, we are able to enter when the statistical edge is in our favor. So let me give you an example. When you look at the stock market, basically there are three things that could happen in the stock market. Okay, the market either goes on an uptrend, it goes on a downtrend, or it goes sideways. Okay, so I'm just going to focus on uptrend and sideways. I'm going to do this in another video. All right, so if I notice that a stock is on an uptrend, for example, now on an uptrend, you notice that a stock doesn't go up in a straight line, right? It goes in wave patterns, right? It's what we call an impulse, correction, impulse, correction, impulse, correction. Okay, and oftentimes when it corrects to a support level, we call this a moving average or support level. And you see this very repeatable wave pattern. It hits that level, it bounces up. What do you think is going to happen? Duh, right? It's probably going to go up, right? So as professional traders, that's when we buy. Because on an uptrend, when the price hits a support level after a retracement, there's a high probability that it's going to go up. Now, is it a guarantee? Is it 100% it's going to go up? Of course not, right? It could still go down. But when you enter at these repeatable price patterns, the chance of it going up, it's more than 50-50. It's not 100%, but let's take it as a 60% chance it's going to go up. Okay? Or even 55%, whatever it is, right? Of course, there'll be a 40% when it fails and the trend reverses into a downtrend. Okay? So say 40% you lose and 60% you win. Okay? What's your edge? Your edge is you win 60%, you lose 40%. Your statistical edge is 20%. That's better than the casino. The casino's edge was only 5.4% and they make billions. Or hundreds of millions, whatever it is, right? But as a professional trader, your edge can be 20%. Now, even if you are right only 55% of the time, some people say that's no big deal, and you are wrong 45% of the time, hey, that's still a 10% edge. So being a professional trader is better than owning a casino, if you think about it that way. Now, here's the other best part. As a casino, when you bet with the players, you're betting 1 for 1. right? If you lose, you lose $100. If you make $100. But in professional trading, we never bet 1 for 1. We always bet at least 1 for 2. In other words, we always risk 1 to make $2 or more. How do we make this happen? By placing a stop loss to guarantee how much we're going to lose, and a profit target to guarantee how much we're going to win when we're right. So let me draw this again. Now, in this case, let me show another example. In this example, the market is going sideways. Usually when the market goes sideways, it's in a range. Like that, it's in a range, right? So it hits what we call resistance, support, resistance. So you have to see this repeatable price pattern. It doesn't happen for every stock. It doesn't happen every day, but when you see it, you can trade it. We only trade when we see a repeatable price pattern, all right? So for example, say this is 10 bucks and this is 15 bucks, right? So the price hits this support level, and what do you think is gonna happen, right? Duh, it's gonna go up there, right? So we're gonna buy here. Again, is it a guarantee it's gonna go up? No, it's just a probability. It's better than 50-50 chance, right? But based on its repeatable price pattern, say the chance of it going up is 60% chance. And the chance that after I buy it dies, it's a 40% chance. Win, lose. Now here's the difference. So say I buy it at $11. What do? I have to place what I call a stop loss order, a stop loss. That says, hey, if it goes to $9, sell it immediately. I cut my losses. Right? So if you do that, how much will you lose when you're wrong? You will lose $2. So by placing a stop loss, you guarantee how much you are going to lose when you're wrong, right? And you just have to make sure that the distance from your entry price, you're buying at 11 to the top of the range, say this is 15, right? So if it goes from 11 to 15, how much you make? You make $4. So you're risking $2 to make $4. Or another way of saying it is you're risking 1 to make 2. You're risking 1 to make 2 with a 60% win rate. And that's how you rig the game of the stock market. Now, if you do this consistently, in other words, out of, for example, 100 trades. Now I do about 20 trades a month on average. So it takes me about 5 months to do 100 trades, okay? Out of 100 trades, again, my win rate is, say, 60% win rate. So I'm gonna win 60 trades. I'm gonna lose 40 trades, okay? Now, each time I lose $1, right? Or whatever I'm willing to invest or trade. When I win at least $2, right? Why? Because like I mentioned, we fix our stop loss and our profit target, and we only take the trade if we have a risk to return ratio of at least 1 to 2. So what happens now? Okay, so I lose $40. I make $120. So you do the maths. What's 120 minus 40? 80 bucks. So I know that, you see, whenever I make a trade, I've got no idea whether it's a win or loss. In a short term, I may have a losing streak, I may have a winning streak. That's called luck, okay? But over many trades, of at least 100 trades, for example, I know I always win because of the statistics being in my favor. I'll make 80 bucks. In other words, if I'm betting $1 for a trade and I'm betting 100 bucks, I'm getting 80 bucks back. That's an 80% return, okay, in 100 trades, which is about 5 months, okay? Now, of course, there's no guarantee that you're gonna win 60%. Now, what if the worst case scenario happens and you get a string of bad luck, right?